So the Silicon Valley Bank, Signature Bank, and others are going broke. What is going on here? Let's talk about it in today's video. Hi, I'm Mike Greiner. I'm a lifelong Democratic activist who's concerned about the direction our country is taking. I'm also a lawyer and an academic, and I'm here to help you stand up to the BS of the MAGA crowd. So bank stocks have been dropping through the floor as the FDIC comes in and takes over the Silicon Valley Bank, one of the 20 largest banks of the country. Still, though, basically a regional bank that lent primarily to Silicon Valley startups. But then we got news that Signature Bank has also gone broke. And this might not be the end of it. Could we be facing a contagion of bank failures like we did back in 2008? Well, let's start by talking about what exactly a bank is, because this is kind of a fundamental to understanding what's going on here. A bank is basically a financial intermediary. I'm going to put up this whiteboard here so I can do some of my world-famous drawings to help illustrate the matter. So basically, you've got the bank. Oh boy, my handwriting is going to be terrible with this. All right, so what happens is depositors who have money put money in there. And then what happens is the bank holds on to it until a time when the depositors want their money back out. But here's the thing is while the deposits are in the bank will turn around and lend out a certain percentage of the money to borrowers. So let's just say that the bank has $100 deposited into it. It might lend out $90, meaning that it still has $10 in its coffers for when a depositor comes and wants some of their money to be taken out. So banks rely upon the assumption that everybody is not going to want to take their money out of the bank at the same time. If more depositors want to take their money out of the bank at the same time, then there's money in the bank to cover those deposits, then the bank goes broke. So, and I don't mean to scare you here, when you deposit money into the bank, only a small percentage of your money is actually being held by the bank. The rest of it is being put back out into the economy as loans. Now, banking in the United States was traditionally a very conservative business, where you'd have small banks basically taking in deposits and then lending out money, typically to businesses or to homeowners for mortgages. The classic case of this is, of course, the famous George in It's a Wonderful Life, who had to make sure he had enough money to cover the deposits that people had deposited into his savings and loan, as I recall. And for those of you who haven't seen the movie, it's not a bad movie, I guess. But in the movie, all these friends of his come together to give him the money to make sure he had the money to cover the deposits. But this all started to change when we started to see a lot of growth in the South and the Southwest of the United States. Because what happened is most of the money, of course, was in the Northeast, which was the most developed part of the country from early on in our history. But yet most of the construction was going on in the South and the Southwest. And that's when banks started to develop these different finance mechanisms to basically transfer funds from where the deposits were to other uses. No longer would a bank simply be taking in deposits and lending it out its own money. Instead, the deposits would be bundled together into certain financial instruments, which would then be sent to other banks, which would then be used to lend out that money where there was extensive construction. The development of these financial instruments is really what started to lead to banking becoming a riskier business. But it's worth noting that even before this was really happening, runs on the bank were a common thing. Banks would routinely fail, and the depositors in the bank would just lose their money. That was all there is to it. When that happened on a grand scale at the beginning of the Great Depression, that's when the federal government stepped in and founded the FDIC, with the aim of making sure that if a bank did fail because of a run on the bank, that at least people's deposits would be insured up to a certain amount. So what you had going on, interestingly enough, were two things at about the same time. On the one hand, banks developed these financial instruments which allowed them to bundle up debt and make investments elsewhere. And the people who owed this debt were frequently nameless, faceless people from far away. It wasn't like the neighbor down the street, the way it used to be with the bank. And at about the same time, this new regulation from the federal government was coming in, which suddenly made it that the risk, if a bank went under, wasn't so great anymore. And really what we've seen since then is a steady increase in the amount of risk that banks have been trying to take to increase their returns on investment. The high watermark of that high level of risk was probably the 2008-2009 recession, which was essentially another run on the banks, much like what we experienced at the beginning of the Great Depression. It's not by accident that these two recessions have so much in common. After we saw the wholesale failures of financial institutions as a result of the 2008-2009 recession, the federal government stepped in with more regulation, that being what's referred to as the Dodd-Frank bill. That legislation put certain limitations on what banks could do and includes certain requirements for banks to have higher capital requirements, for example, to make sure they had enough money to pay back depositors if those depositors came demanding their money back. Part of the way the bill was crafted, though, is it only really impacted the largest banks. There was a theory that there are certain banks that were just too big to fail. Remember hearing that term? And those banks should be subject to more stringent regulations than smaller banks, which, number one, don't have the systematic risk to the entire economy the way large banks do, and number two, actually, had relatively low failure rate during the 2008-2009 recession. It wasn't these smaller regional banks that were requiring bailouts. They were the large financial institutions. And as a result, the restrictions on the smaller banks are quite a bit less stringent than those on the larger banks. Well, of course, now we have our moment with a smaller bank. What has put these banks at risk? Well, you see, these banks end up having all kinds of investments to simplify things in the form of loans to other people. Let's just say they lent out a bunch of money at a 3% interest rate, which was pretty common back before we were dealing with the inflation crisis that we're dealing with now. Since then, of course, the Fed has increased the interest rate to between 4.5% and 4.75%, and it's likely they'll be increasing it even higher. So all of a sudden, these loans at 3% don't look like such good investments. Certainly not when compared to the situation when interest rates were at close to zero. This situation where interest rates that the Fed has set make the investments that the bank had previously less attractive are called unrealized losses. And word is that Silicon Valley Bank had a substantial amount of them. Now, Silicon Valley Bank, operating in the Wild West financial environment of Silicon Valley, of course, decided that they needed to turn around to do something to resolve this issue. Well, of course, word got out that they were taking these extreme steps to try to make their balance sheet look better. And when word went out, suddenly all these companies in Silicon Valley that had their money invested in this bank wanted their money out. You see, even with the protections that the FDIC brings, those protections only go up to $250,000. Well, say you're a large business operating in Silicon Valley and you've got payroll in excess of that. Well, obviously you're going to have more money sitting in the bank. And the concern is, if you don't get your money out, you'll lose at least some of it. So you had this situation where all these different businesses in Silicon Valley suddenly wanted their money out. The Silicon Valley Bank didn't have enough money to pay it back, and they were taken over by the FDIC. Now, one thing we've heard a lot about ever since the Great Recession of 2008-2009 are bailouts, of course. And the question is the federal government engaging in a bailout here? Well, the answer is either yes or no, depending upon who you ask. The answer is yes, in that the federal government is coming to the table and saying that it will guarantee all deposits with the Silicon Valley Bank, even those above $250,000. That in essence, the Silicon Valley Bank opened up today, again, under the control of the FDIC and just kept operating like it never closed in the first place. So in terms of the federal government stepping in, was this a bailout? Well, yes. And ultimately, if there aren't enough funds on hand in the insurance fund that is set up for this, that the banks pay into, then ultimately the Treasury backstops that and provides additional funds if needed. So is it possible if we have more bank failures, this could ultimately lead to taxpayer dollars being used? The answer to that is yes as well. The Biden administration, though, argues that this is not a bailout, though. Reason being that, unlike in 2008 and 2009, when you had people losing their homes and losing their jobs, and yet the bank shareholders and top executives were making a killing, in this situation, the bank's shareholders are wiped out, as are its bondholders. So anyone who is an investor in the bank is losing all their money. What the federal government has made clear is it's only going to protect the money of the depositors. Just as an aside, the Obama administration's handling of the 2008-2009 recession and their decision to fully bail out the banks and make the investors in these banks whole is really, in my opinion, one of the biggest mistakes that Barack Obama made, and is nothing short of an outrage. At any rate, Biden has pledged not to do that here. He's pledged that, number one, all the funds for this rescue will come solely from the insurance fund that's set up. that only banks pay into, and that he will ensure that no taxpayer funds are used for this. And secondly, because the investors and bondholders and top executives aren't making out like bandits the way they did back in 2008 and 2009, the federal government's basically not enriching the very people who caused the problem in the first place. So from that perspective, is it a bailout? Well, no. I'll leave it to you to decide that. But one thing is clear, and that's that President Biden had to step in and do something. And he certainly did that when he went before the public and gave a speech urging faith in our banking system. That's ultimately the most important thing the banking system needs. Faith. Banks have been called a big confidence game because ultimately you're having faith that when you want to go take out your money, the money will be there for you to take it out. If everybody wants their money out all at the same time, the system collapses. It only works if only a tiny minority of the people who want access to their deposits want it at the same time. So it's important for President Biden, number one, to make it clear that depositors would be protected, and number two, to urge confidence in the system. Because if everybody gets nervous, you can see where the whole system would collapse. And the reality is, we rely upon banks to make our economic system operate. If we do not have a healthy banking sector, then literally all economic activity across the country will grind to a halt. So this is not a small issue. Part of the reason, by the way, why Barack Obama felt it was necessary to completely bail out the big banks back in 2008, 2009. But the inequity as to how it was done really rubbed some people raw, including me, by the way. On the other hand, it appears here that President Biden is trying to walk the fine line that exists between making sure that people have faith in their deposits in the banks, while also making sure that the federal government is not backstopping bad decisions, where essentially we privatize investment gains, but socialize investment losses. And just as an aside, isn't it funny that some of these people calling for the federal government to fully bail out the Silicon Valley Bank and other banking institutions would be the same people who say we shouldn't grant relief to student loan borrowers? Well, if you want to see another video about how our economy operates, why don't you check out this one over here that I did a little while ago, describing why we're having inflation. I'll see you then. In the meantime, let's hope for continued progress. Thank you.